Good afternoon, ladies and gentlemen. This is Josh Horton here with Pinnacle Financial Services, and we want to thank everybody for taking some time out of your busy day to be with us today to do some training. And we're very excited today to have one of our biggest partner carriers, Lincoln Financial, with us, and our Regional Marketing Director for the MoneyGuard product, Tim Lockwood. Tim, you there?
I am.
All right. And as I mentioned, very excited. Lincoln is absolutely one of our top companies, probably our number one carrier this year for life insurance and for some of these hybrid long-term care solutions that we'll talk about today. So just for the sake of everybody's time, we'll kind of jump right into the material. But before we do, just a couple of housekeeping items. And a little bit about us here at Pinnacle Financial Services. So if you haven't spoken to me before, again, my name's Josh Horton. I'm our Senior Sales Director for our Life, Annuity, and Long-Term Care Department. You can see my extension 7707, and I'm happy to help with any of those areas, anything life, annuity, long-term care related. You can definitely feel free to reach out to me there. And if you're already working with us, thanks for your business. Sorry for the little bit of a review, but if you're not working with us, we are an independent brokerage firm, FMO, IMO, if you will. That's really just some industry jargon for what the insurance companies refer to us, but we're really a partner with our agents, and that's what we really strive to do, is be a really good partner and help our agents grow their business. So if you're working with us, any contracts that you have with Pinnacle will be direct contracts. For example, Lincoln Financial. If you're working with Lincoln, you're paid directly by Lincoln. You're fully vested with your commissions with Lincoln. And we'll talk a little bit about some of the commission opportunities and bonus incentives that we have here at Pinnacle at the end of the call today. But I will say that our commission situation with Lincoln is very good. So with that said, I want to kind of jump in and pass things to Tim. Your phones are on mute today. Just we have a lot of agents on the call. Really excited about this new MoneyGuard 3 rollout. And so if you have any questions at all, please feel free to enter those questions in on the question box there on the right side of your browser, and we'll be happy to get to those questions. Most likely probably at the end of the call. I think Tim and I had said we'll try to keep it to under an hour today, and again, we really thank you guys for your time. We know that if you're here with us doing some training, you're not out there in the field, so hopefully this will benefit you to help you generate some more MoneyGuard sales moving forward. All right, so Tim, I'm going to turn the controls over to you here. If you give me 1 second. Sorry, guys, if we have some background noise here. We have a lot of agents in the office today. A big buzz around our open enrollment period. We do a lot of Medicare here. So, all right. I see you there, Tim.
All
you are
right.
Good to go.
Thank you so much, Josh. First off, I want to thank everybody for logging into the call here, the WebEx go-to meeting, if you will. As Josh mentioned, my name is Tim Lockwood. I'm the Regional Marketing Director in the Mid-Atlantic, Northeast part of the country. I have been with this team going on about 13 years here. I joined in 2007. So any questions we have during the end, I'd love to be able to address them. I do want to give a big thank you to the Pinnacle team. You have a great team behind you supporting your practice. Today, what I really want to go over are really three items. One, I want to talk about the why and Lincoln's approach to LTC planning. With that, I'll give you some ideas on how you can really approach and ramp up your LTC sales. Number two, I want to introduce MoneyGuard 3. We're really excited to launch our newest generation of the MoneyGuard product. And then lastly, I want to really wrap up with where our core markets are, because some of you on the phone may be in the position of, I've heard of MoneyGuard before, or I sold a MoneyGuard policy, a decade ago. Well, today we've really created a lot of flexibility and the ability to customize these plans. So I really want to wrap up the call with outlining our core markets and sharing some case studies. So I'll get right into the content. And all of our material is really available online. But, as you think about this, a lot of people will generally tend to lean on statistics. And statistics can be great in a lot of scenarios. But when we think about healthcare planning, and specifically extended healthcare planning, this is really an emotional sale, right? And if I just did kind of a virtual poll right now, of how many of you on the phone have had a long-term care or an extended healthcare event with a loved one or a family member, half of the hands are going to go up. It's just standard practice. More than 1 out of 2 of us, 3 out of 4 of us have a story. So part of the key is understanding that story and getting to that story with your clients. Because once you get to that story from your clients, you know how emotionally that has impacted them. You also get an understanding of whether they understand the costs, understand how Medicare does not cover that long-term custodial care, and really the impacts to the family. Not only financially, but physically and emotionally as well. So again, create that engagement with your clients. Ask them about their story. If you get their story from them, the planning process really should be downhill from there. When we talk about hybrids, a lot of people think, all right, well, how is this different than traditional long-term care? Well, I'll tell you, the policies out there today, specifically with MoneyGuard, cover all, if not more, of the same covered services. Now, I'll tell you, as I get out in the field and get in front of agents and advisors on a day-to-day basis, the goal is to keep your families in their homes. The goal is really never to put Plan A in place, and Plan A is to go into a facility. Going into a facility is Plan B at best. So the key is how do we keep your families in their home? Are you going to live a long life? Are you going to do you have the potential to become frail as you age? If you become frail as you age, could you potentially need some assistance, right? So the reality is we want to plan to allow our clients to stay in their home. That's why we've rolled out a 0-day wait. Lincoln has a 0-day wait or no elimination or deductible period for all covered services, regardless of whether it's in-home or in a facility. One thing that we're doing with MoneyGuard 3 is we launched a transitional care benefit, which actually allows for a limited cash benefit on a monthly basis. And essentially that could be up to 4 to 5 days a week where we could pay out $100 a day, no receipts, which we really don't care who that goes to with the exception of the spouse. So we're evolving the solution to really make it easier at claim time for your clients and make the benefits more widely and readily available. Our new cash benefit is up to 180 days in the first year of the contract, really to help transition that care, because the reality is most families don't have a written plan in place. So they don't really have that written plan to tell their family members, oh, I want to stay in the home. Here are the home health care providers that I have vetted out. So we create some flexibility to be able to pay that $100 a day to the adult children if that's really where it's going to go. And it's under the condition that we have at least some formalized care coming in 2 out of 7 days a week. So really trying to make the benefits more accessible on top of our concierge care coordination program. Now, we talk about costs, right? I'm not a huge fan of this slide. There's 2 things that you always got to emphasize when you think about costs. Number one, where in the country are you? And more importantly, where are your clients going to retire and potentially need that care? Because where they need that care can vary significantly when we start breaking down the costs. Also, the quality of care, the higher quality of care, should I say, could be easily 150% to 200% of the averages. So if you're dealing with a wealthier family, in their circle and their network, they probably are getting referrals to some higher end facilities. So, and again, going back to the plan to stay at home, part of the planning process that we take with planning for these costs is come in and cover up to the home health care costs or the cost for an assisted living facility. If we have a client that has the means and has the assets to fully transfer the risk, by all means, we can come in and cover anywhere between 90 to 100% of that high-end risk, which could easily be up to $120,000 to $140,000 a year. But don't think that you always have to fully fund 90 to 100% of the risk. Think of an idea of funding and protecting against 50 to 80% of the risk and use that as a starting point to engage your clients, because something is better than nothing, especially when we talk about leveraging dollars, creating concierge care access, and also tax-efficient dollars for healthcare. So this is really a cash flow issue in retirement. Now, part of the why for agents that I really try to emphasize, and the beautiful thing about working with Pinnacle, is that you really have a tremendous amount of alternatives in today's market than you ever had before. If I go back a couple decades, you had a tremendous amount of traditional long-term care carriers with products. Now, unfortunately, the traditional carriers have really decreased significantly. There's only a couple players in the traditional space. The good news is they've stabilized. Now, when you look at the bottom line item there, hybrid life long-term care, there are more solutions within this realm of products than you've ever had before. Most of them are guaranteed. MoneyGuard is a fully guaranteed product and would fall under the hybrid life long-term care, otherwise known as a linked benefit LTC contract or even an asset-based long-term care contract. But the reality is, if your clients need life insurance, you have life insurance alternatives with chronic illness riders, long-term care riders. Lincoln just rolled out a long-term care rider on our life portfolio. Now, it's important to note, those life contracts with the riders are really designed for life insurance first. The long-term care is secondary. But when we look at MoneyGuard, which I consider an asset-based long-term care contract or a linked benefit hybrid policy, what we're doing with MoneyGuard is solely to drive the long-term care benefit. And we'll get into that story in a minute. As far as the family members providing care, don't push back on that. Your client's family members are absolutely going to step in and provide the care. What you want to do is help them plan and deliver the most effective and efficient plan and allow the family members to be the care managers, not the caretakers. And when you think about Medicare and Medicaid, Medicare doesn't cover long-term care. It might cover some short-term care or some medically necessary care in a facility given a 3-day hospital stay. But there are a lot of limitations to that, which I'm sure a lot of the folks on this call are aware of. But the key is you have more options from a planning perspective than ever before. So the consistency and the pivot points in working in extended care planning into your practices, can really drive a good amount of revenue for you and help a lot of clients who have a big hole in this part of their comprehensive financial plan. So, why haven't traditional long-term care carriers grown? And why haven't they gained market share? Because the reality is the market share for traditional long-term care hasn't penetrated more than 7 to 14% of the American population. And the reality is, while they are good products and offer very solid, meaningful benefits, clients who have built up wealth don't like the fact that the premiums are not guaranteed. If they never need care, those premiums, are lost, right? And they kind of look in the mirror and say, you know what, I built up this wealth. I can earmark some lazy assets to be able to pay for this down the line. In other words, I can self-fund the risk. So this is really where the MoneyGuard story was born. The MoneyGuard story was born to really give those clients who wanted to self-insure an alternative, right? And what we do with MoneyGuard and what you think about the strategy of a self-funded plan, generally what I've heard over the past decade is, Tim, my clients want to self-fund. They like the fact that they can maintain control over their assets. They're not paying annual premiums that can increase down the line. And most importantly, if they never need care, those assets stay in the family. They stay with the estate. They go to the kids, right? And, but the downside risk of that self-funded plan is obvious. It's clear. They might not have enough set aside. And what I always emphasize about not having enough is the twofold, right? Number one, your clients could be spending down their entire portfolio that they've worked a lifetime to build, and they'd have to then fall back on and rely on Medicaid, which is not the worst thing, right? But the other part of it is we might have wealthier clients that are going to burn through their liquid assets. So it's not almost enough assets there, but it's how much is liquid and readily available and not exposed to the tax risk or the market risk. Right? So this is really where MoneyGuard comes in. We offer guaranteed premiums, right? So you're not paying annual premiums that can increase. We have no elimination period. So just like your self-funded plan, you have access to those funds immediately upon claim time. On top of that, we offer return of premium options. So we allow your clients to maintain control over their assets. And just like that self-funded plan, we're going to offer benefits regardless of whether your clients need care or not. Your clients and their families are always going to see their premium dollars back, and I'll walk through how that works. But the biggest reason for MoneyGuard is to leverage those assets to mitigate the downside risk of not having enough and essentially pay pennies on the dollar, right, for your care. Why would your clients want to pay full price for their care when they can pay 25 cents to even 10 cents on the dollar? And I'll show you how that works in a minute. So as we are excited to launch MoneyGuard free, I'll remind everybody on the phone who might not be familiar with MoneyGuard. Lincoln brought the MoneyGuard concept to the marketplace in 1988. We have been processing and managing this business and more specifically processing claims for several decades. So we have a vast amount of experience in this business. We essentially created this market space and have maintained the market leadership position year over year since inception. We've essentially managed at least 50 to 80% of this market share here for the past decade. So we're excited about MoneyGuard 3. There's a lot of flexibility. And as I noted in my introductory comments, the ability to customize these solutions. But what you're going to see here are 3 piggy banks. I refer to them as my 3 buckets. This is as simple as this concept is. Because when you think about this, and I go back to your client self-funded strategy, they like to maintain control over their assets. With that control, they have accessibility to those assets, liquidity. We offer that with return of premium options. We're also going to allow them to pass these benefits on to their beneficiaries should they never need care. That's where the middle piggy bank comes in, because every dollar that they don't use for care within that death benefit passes on to their named beneficiaries. And if they're one of the lucky ones that never needs a dollar for care, we're going to be able to pass these assets on to their beneficiaries tax-free, generally with a little bit of leverage. Now, when you look at the first piggy bank, the biggest piggy bank, that's what this story is all about. That is the long-term care bucket. We are providing leverage on their dollar. So $1 will potentially leverage up to $4 to $5 for our client. And it's tax-free and it's guaranteed. So one of these 3 things is going to happen, right? Most likely it's either paying out long-term care or paying out a death benefit or a combination of both. Now, when you think about the return of premium options, if you haven't heard our story in a while, nobody quits and walks away from these policies. Nobody. So unfortunately, all insurance carriers are in a very low interest rate environment. So what that does is it puts pressure on pricing. One way for us to free up pricing is to offer reduced return of premium. But the reality is less than 2% of our policyholders ever quit and walk away. So what we've done is we've introduced this basic liquidity option, which is option 1 on your screen, that offers a 70% return of premium. And again, less than 2% of our policyholders ever quit and walk away. So believe it or not, while a lot of people think that this is a place for money managers to park assets, the vast majority of our business comes in and is designed with option 1 with the 70%. Now, you might be asking, well, why would somebody choose the 70% option versus 100% return of premium? Well, it's additional and more favorable benefits and pricing. It's actually a pricing change of about 15%, give or take some percentage points. So do I want max long-term care leverage or do I want max liquidity? So we have transitioned to a 70% return of premium. I've had a lot of my long-term care producers say, Tim, I wouldn't care if you just removed that third bucket altogether, because they're not selling it off of this. And it's not uncommon for advisors and agents to tell me, Tim, I'm not putting this plan in place for my clients to ever quit and walk away. If that third bucket or third piggy bank is a concern for them, this is probably not the right product for them. But we allow them to mimic control of their self-funded strategy, allow them access. And you know what? With option 2, if they want full access to 100% of their premium, we can design the contract for them like that. That's not an issue. But the reality is 96% of our business is now designed with this option 1 because nobody actually exercises return of premium. They either have other assets on the sidelines or they see the value in just passing the assets on to their named beneficiaries as part of the legacy planning process. Now, when we look at long-term care, you have reimbursement or indemnity. Lincoln believes in the reimbursement structure. Now, the beautiful thing with hybrid long-term care is we know we're always going to pay out the first couple of years of long-term care because we're guaranteeing a death benefit. So we don't really give any trouble or push back on claims. As long as you meet the triggers, which are 2 out of 6 activities of daily living, that is limitations in those 2 out of 6 activities of daily living, and that's expected to last longer than 90 days, we're going to turn on your claim. And as I referenced earlier, there's a 0-day wait. What we have done and how we've evolved making this process easier is we rolled out a direct deposit last year. With that direct deposit rollout, we rolled out some additional technology where we can initiate the claim online. As I may have referenced earlier, we process all of our own claims. So it's a Lincoln claims advisor who will hand-hold the claim when your client needs care. And what I've found over the years is that the family members of our policyholders get to know our claims advisor pretty well in that time of crisis. The other thing that's really important is we offer concierge care coordination. That's a combination of our claims team, but also a web portal that we refer to as Silver Brick Road. Your policyholders, your clients, will have access to Silver Brick Road day 1 after policy placement. That's important. Because some other care coordination programs don't become available until we're on claim. And for me, personally, that's a little bit too late. We want to give the families the tools to be able to plan in advance, to plan to stay at home, to plan to prioritize care providers, to understand and communicate to the family with the social media care circle and keep the family involved around what that plan is. So also with the reimbursement, we don't have to worry about HIPAA limits, per diems. Lincoln also takes the fiduciary responsibility to ensure that all the benefits are paid tax-free. Excuse me. So very important there on the claims value proposition. Now, as I really shift from our basic bread and butter story to where the market is, this is really what I get excited to talk about. Because when you think about how our business has evolved, I'll take you to the cash-strong clients in the upper left-hand corner. This was really our marketplace when I started 12, 13 years ago. We were looking for cash-strong clients who were 55 to 75 years old they had a higher net worth, and they probably had a good amount of liquidity on the sidelines. It was really that client with a higher net worth that had a CD coming due or some cash sitting in the money market. And the story was, what is that cash on the sidelines for? Oh, an emergency? Would you consider a healthcare event an emergency? Absolutely. Well, let me talk to you about repositioning that asset from the left pocket to the right pocket. And if you have that emergency and it is healthcare related and extended healthcare related, well, we can leverage your dollars. Would that be something you're interested in? I actually recommend that you do something to protect the remaining assets within the portfolio. That was the story of our cash strong client. It consisted of a single premium sale. But what we've done is we've made MoneyGuard more flexible, and the evolution of our flexible premiums, not only more client friendly, but more advisor friendly. And that really comes down to annualizing revenue and simplifying the overall story. More than half of our business now comes in with a flexible premium. And we're bringing in over $1.5 billion in premium every year. We've essentially been bringing in over $1 billion in premium since 2011. So while those cash strong clients might still be the low hanging fruit, you have retirees who might want to refocus some IRA dollars and make some distributions in advance to manage the tax exposure on that, right? You have clients who are going to have to take RMDs. What is better for your clients in their mid 60s, the late 60s? Take an annual distribution from their IRA on their terms and manage the tax risk, say at a clip of 10 to 15 grand a year, or run the risk when they're in their late 70s or mid 80s and be forced to take out 10 to 15 grand, not a year, but a month, not on their terms, subject to that tax exposure and that market risk. Why not parlay some of that cash flow, start taking the distributions early and put it into MoneyGuard, use the back end of that premium schedule and leverage those RMDs to fund the back end of that contract. The other opportunity here with these retirees is to do a policy review. It's one of the oldest strategies in the books. Let's do a policy review. Do we have a UL or maybe a VUL that's not performing well that might blow up? Well, that could be an exit strategy. We can 1035 from life insurance in the MoneyGuard for those policies that might need some help or might need additional premium to go into those contracts. You also have all these clients that might have been paying into whole life contracts for many, many years, and there's no acceleration benefit on those contracts. So, getting some long-term care protection is more important at this point in their lives and in their stage of life, than having life insurance alone. Now, what I get really excited about this slide is the right-hand slide, right-hand quadrant of this slide. When you look at your pre-retirees and your young professionals. And one thing that sums this up is the fact that our issue age has decreased by over a decade over the past decade. So when I started in 2007, our average issue age was 66, 67 years old. In today's market, our average issue age is pushing 66 and sits right at 57 years old. So we're seeing clients pushing 55, 56 and younger looking to plan. And when you look at the bottom right here into the upper right-hand corner, these young professionals, think your business owners, think of your corner office executives, think about your folks that are approaching retirement in their mid-60s that are getting ready to retire and may even still be on the company healthcare plan, but are looking ahead to enrolling in Medicare. It's a great opportunity to offer some flexibility and lock in some coverage at an earlier age. Maybe these are the adult children of your older clients, right? So the leverage on these is tremendous. And what we've done is we've expanded our issue ages with MoneyGuard 3. We can issue as low as age 30 and as old as age 80. And what we've also done is we've expanded our flexible premium design. So for most clients up to age 72, I can do anywhere between a single premium to a 10 pay. So it really creates a lot of flexibility in the funding pattern while you're still locking in guarantees, right? For anybody younger, I can fully fund up to age 70. So for my 30-year-old, I can fund over 40 years. For my 50-year-old, I can fund over 20 years. So there's definitely flexibility. And I can do a 10 pay all the way up to about 71, 72 years old. So when you think about that RMD play for your retirees, why not leverage that RMD to fund one of these contracts? A lot of people out there don't need or even want to take an RMD, right? So let's take a look at a couple of case studies. Susan is really our bread and butter, our poster child of this business, age 70, just above our average issue age. We just look at a 6-year benefit duration, looking at $100,000. One thing we've done is we've simplified the long-term care benefits by simplifying the riders. So there's only one long-term care rider that delivers all the long-term care benefits. But in reality, Susan, has some CDs rolling over, maybe some money market accounts, and she would have otherwise spent that $100,000 down dollar for dollar. By repositioning those assets, or in other words, moving that sticky note that says in case of an emergency from that CD to MoneyGuard, that $100,000 now turns into over $470,000 in a long-term care bucket. Now that is spread out over 6 years. You actually are going to have even more flexibility on the benefit duration. Josh and his team at Pinnacle will put you in the best position with the plan design. But the reality is that $100,000 now turns into about $78,000 a year in tax-free long-term care. That is spread out at a pace of $6,500 a month. Now, the best case for Susan is she never needs care. She never needs care. She lives to an old age of 115 years old, and she passes away in her sleep. That's really the best case scenario for all parties involved. Susan, her family, even Lincoln. Because then we just pass on a tax-free death benefit of $170,000. Now that middle piggy bank, look at that as a return of capital, right? Because while Susan has access to 70% of her premium with the basic liquidity option, she could call Lincoln and get that $70,000 cut at any point. When you look at the middle bucket, that's really a replacement of that opportunity cost or a replacement of capital. And what you're going to see is that Susan, might not be able to fund this with a single premium and funds over, say, 10 years. You can see the death benefit is closer to that premium now, right? And as we add inflation options and extend the premium flexibility out, that middle bucket turns into essentially a return of premium at death. That's why I really position that middle bucket as a return of capital. So that's really what you want to look at there. Lincoln is not really trying to create a tremendous amount of leverage on the death benefit. It's really about this long-term care bucket. And if Susan doesn't have the liquidity, but she can make 10 premium payments of $10,000, we lock in a bucket of over $360,000 with just 10% of the overall premium outlay. That's guaranteed immediately, and we're essentially on the hook to pay out about $60,000 a year at $5,000 a month in the event she needs care, right? So I want to jump ahead real quick before I come back to Victor and Gail, because I'm going to come back to Victor and Gail, but I want to show you Ryan very, very briefly. And I understand that Ryan might not be in the wheelhouse of a lot of folks on this call, but when you think about your younger business owners or your adult children of your wealthy clients, this just highlights the flexibility and really the power of starting early. We can put these contracts on a monthly bank draft. In this scenario, we just repurpose $400 a month. Ryan's maxing out his 401k if he's not self-employed, and he's really maxing out a lot of these tax-sheltered plans, retirement plans. So he puts $400 a month away. Mom and dad, have some health issues. His grandmother needed some level of care, so he sees the family history and wants to get a plan together early. So this $400 a month over 25 years is about $120,000. Keeping this very high level, that $120,000 turns in to over $2.1 million at average claim time, age 84. And that's the power of the inflation protection. He is going to have access to over $25,000 on a monthly basis in the event he needs care. And that translates to over $310,000 annually. So when you think about it, what he's put in versus what he's potentially going to get out is a tremendous leverage point for him. And he's essentially paying about 5 to 8 cents on the dollar, come mid-80s. And what happens is when you look at that middle bucket, you might be saying, well, Tim, I thought you said the overall premium was 120. You're showing me 78 grand on the death benefit. Well, we allow that death benefit to be lower than the premium. But what happens is Ryan's family will see nothing less than the premium he puts in. So once he's fully funded, this middle bucket will kick up to $120,000, should I say. So I want to hop back now to Victor before I kind of close up, talk a little bit about underwriting before I hand it back over to Josh and his team. But Victor and Gail are a case, I really want to show this to you because I want to show you the ledger and how the inflation option works, right? Now, Victor has all of his kids' college tuition squared away. What we're trying to do is we're solving for about a $16,000 monthly benefit at average claim time, age 84. So with Victor, we can actually fund this over 15 to 20 years. In this particular case, we solve for a 15-year premium. So that shakes out to be about $92.82 annually. The overall premium outlay is about $140,000. So that premium outlay of $140,000, when we talk about pure leverage, it's about 8-to-1 buying power for him. When you think about a $1.2 million long-term care pool over that 6-year period of time. Now, again, I've been focusing a lot on this monthly and annual benefit because annually, if he needs care, Lincoln is contractually obligated to cover up to $196 grand a year. And you can see the death benefit is about $156,000 on top of that $140,000 outlay. So not a tremendous amount of leverage on the death benefit. But again, that's not why we're doing this, right? It's really just to replace that capital and pass all that premium on to the family in the form of a tax-free death benefit. Now, before I wrap up, I want to show you a quick case study on what this looks like as far as an illustration for Victor. So this is Victor, and this is the exact case study that we just looked at. Number one, here's your transitional care benefit and all your benefits that he's going to have access to. Actually, I should take that back. It's not all of them. It's the majority of the most common care services and benefits. But I will bring your attention to the transitional care assistance, which is that $100 a day up to 180 days in the first year in cash. And then another important one is this alternative care services provision. That alternative care services provision has historically been in our contract. And that really creates a tremendous amount of flexibility for us to really cover anything that is directly assisting with ADLs and in the doctor's plan of care. The only exclusion for the alternative care services is we're not going to reimburse immediate family members outside of that traditional care program. But getting to the numbers here, with Victor, that future benefit of that $16,000 a month actually starts out at about $6,000 on a monthly basis. Here's your 3% compounding inflation, your minimum benefit duration. Now, I emphasize minimum because the benefit pool can last as long as you need it. So if Victor uses 50% of the monthly benefit, his benefit pool would last 12 years. And as I highlighted earlier, we have a 0-day wait. There is no deductible. For our competitors who have a 90-day wait, that could add up to significant out-of-pocket costs, right? We're always going to offer residual death benefits. So if we fully exhaust and accelerate our life insurance, there's always a floor on the death benefit. Look at that as a final expense benefit. And then we always over-disclose our long-term care benefits charge. That's embedded in the contract, and the cash value within the contract actually funds that. Now, this is really what I want to show you, because right at the top here, you see that all values and benefits shown are guaranteed. This is really simple to present. Really easy to understand. So when you look, a couple things I want to point out. One thing is your return of premium locks in on your surrender value immediately as you fund the contract. That is something new with MoneyGuard 3. And once you get and you're fully funded, you can see you have access to 70% of all your premium put in. After 10 years, you would have full access to the entire 139 and some change, 100% return of premium. You also see that you got a minimum guaranteed death benefit, right? But what I want to bring your attention to is the right side here, the column where your monthly benefit grows from $6,000 a month to what's on the slide of about $16,000, right? And actually, we quoted age 84. So when we look at age 84, 85, here's where you see that $16,000 a month and $3.1 million in your total pool. Meanwhile, Victor's got a fully paid up contract. So, he's done after that premium schedule. Now, you might be asking, what if Victor asked if he could pay this off early? There's a couple tools within this contract, specifically this premium options report, that outlines all the premium options. So if Victor wanted these same benefits and liked the way that we were designed, but said, you know what, I just got an inheritance, my Aunt Margie passed away, I just ran into a windfall of some cash. Can I just pay this off once, and do I have any premium savings? Well, absolutely, you do. And you can leverage this report to show him that if he just fully funded this in 1 year, the premium outlay will be $92,000, and he'd have a fully paid up contract. Now, if he wanted to free up the cash flow and maybe lessen his annual premium, we could fund this over 20 years. And you see at the bottom here, my premium to get the same benefits over 20 years is about $79.21. So this report is your friend. It shows the flexibility in the funding pattern. It will also show you the overall flexibility if we're getting closer to limited flexible premium. So, for example, if we have a 74-year-old and we design the case with a 3% inflation, it will show you all the available funding patterns given some restrictions. And then lastly, before I just highlight our underwriting process, there's a lot of flexibility in designing this. Two things are going to occur. You might have a client who has experienced Alzheimer's in their family and went through a claim that lasted over 10 years. So being able to design a longer term benefit duration might make sense. So you could design a 7-year option. You also might want to put in a 5% compounding inflation option in which MoneyGuard 3, we've created a lot of flexibility to be able to add more inflation options. So for Victor, moving forward with our newest generation of MoneyGuard, I'm going to argue that we should put a 5% inflation option on this. He'll have closer to $1.5 million, and we're going to give him an additional, $3,000 on a monthly benefit. So, given this 5% inflation option, I would certainly look at that as a very powerful tool, especially when you think of that growth being fully guaranteed. And then you might also have clients who haven't had a long-term claim. in their family as far as Alzheimer's. So they might be more comfortable with the shorter duration, going 4 years. You can see this report is very advisor friendly, showing you how we can max out those benefits. So with that, there's a lot of flexibility in these contracts. There's a lot of opportunity to customize the benefits. As I mentioned, Lincoln's approach to long-term care, it's all about getting some coverage in place and having a plan. That plan doesn't always have to be protecting against every dollar of the potential risk. You have flexibility in funding. You have MoneyGuard 3, which is now widely available in every state with the exception of California and New York. We do have some other options in those states. And, you got a wider market, so you can cast a much wider net as far as your options for care planning. So, with that, I will just hit on very briefly our underwriting process, because we streamline the underwriting process. What does that mean? We do not get medical records. So we do a script check and an MIB, and then you prep your client for a phone interview. Once our phone interview is completed, we get a pass-fail decision within 5 to 7 business days. And the underwriting class is pass-fail, so you don't have to worry about managing that opportunity. So when you think about this opportunity overall, all your clients have a plan right now. It's whether that plan is a reactive plan or a proactive plan. If it's a reactive plan, they're just self-insuring and they're going to spend their own money down dollar for dollar or potentially rely on Medicaid. A proactive plan would be a plan that they put on paper that includes transferring some risk and making sure all their family is well aware of what that plan looks like. So with that, Josh, I'd love to open it back up for any questions we may have, and I really thank everybody with their time. My team is behind Josh and the Pinnacle team to help out and support your LTC planning needs.
Awesome. Thank you, Tim. Lots of good stuff there. I love the new flexibility options, and I think that'll really lend itself to some sales that maybe we wouldn't have had in the past. I'll just kind of switch things back for everybody, and I know we did have a couple of questions. I think you actually answered a couple of these questions, Tim, but I think we had a couple of New York state agents on the call. One of the questions is this available for New York, New Jersey, Connecticut, and Pennsylvania? So I could just kind of hit on that. It's definitely available for New Jersey, Pennsylvania. Tim, maybe you could speak to some of the differences with New York State and Connecticut.
Yeah, so Connecticut, there's no differences really. We have our money-free product rolled out in every state with exception to California and New York. New York is a little special, as those on the phone who are in New York are probably well aware. Our MoneyGuard Reserve, which is a very similar 3-bucket strategy, is currently available in New York. We do have a cutoff for any cases until November 15th. We need the Pinnacle team to get the business into Lincoln in good order by November 15th. Unfortunately, right now, we haven't launched the new solution in New York yet, but our team is diligently working to get the newest generation approved in New York, which may or may not be MoneyGuard 3, most likely not, but some version of MoneyGuard customized for the state of New York. So if you have any cases, any opportunities that you want to look at, make sure you're licensed. And we have until November 15th for the Pinnacle team to get that to Lincoln in good order and place that business by the end of the year.
Awesome. Well, that's good. That'll help us stress some urgency, I'm sure. That was kind of it question wise. I wanted to add just a couple other things that I didn't mention at the beginning. So for you folks out there that haven't worked with us here at Pinnacle, we do everything from start to finish with our agents with respect to case design, illustrations, reviewing the case, discussing the client. So again, there's my direct line extension one more time. You can see the whole entire Pinnacle Life Annuity and Long-Term Care sales team on our website, but that extension there, 6003, if you don't get through to me, that will patch you through to one of the other members of the sales team, and we'll make sure to get you whatever you need. So any of those example illustrations that Tim showed, we can do illustrations like that for you here in house, save you the time, or we can help with getting you up to speed so that you can run those illustrations yourself. We can go through and do one-on-one training with how to do those. Or, as I mentioned, a lot of our advisors really just like to lean on us, and we're happy to do that for you. We do illustrations here in the office for agents all day. So, anything regarding that, any other questions that anybody has, you can reach out to me directly there. And I mentioned commission-wise, there's some really exciting stuff that we're doing with Lincoln. So the commissions, we always kind of keep things general for commissions. We have some different agencies and some different arrangements with respect to the agents on the call. But we are offering a 1% bonus on all MoneyGuard sales for any of the agents on the call today. So, we'll be reaching out to everybody after the call for the folks that made it on, just to check in and see if you have questions, or even better, maybe you had some prospects or clients that came to mind during the sale. And we're happy to work those cases through with you and make sure that you guys receive that additional bonus on any MoneyGuard related business. So I said we would keep it to about an hour. I think we did pretty good on time there, Tim. If there's any other questions, as I said, or any other cases that pop up, we love to hear from you guys and help you grow your business. So for myself, Josh Horton here at Pinnacle, and for Tim, we really thank everybody again for your time, especially if you're doing Medicare this busy time of year. And we really look forward to working with you some more in the future, and hopefully helping you generate some more MoneyGuard business. So we thank you guys again for your time, and look forward to speaking with you in the future. Thanks again, everybody. Have a great day.